Hi, everyone. I'm Andrew with Jesani Wealth Management. And within our multi-dimensional asset allocation strategy, there's really 11 core components. There can be one or two more or one or two less, but two of those components are using real estate as an asset class to diversify the portfolio. Now, the actual types of real estate that we're using is typically either real estate syndicate investing or, of course, REITs or real estate investment trusts, which can either be public or they can be private. But before I kind of go into details on those, I want to just discuss in a general sense some of the pros and cons of using real estate as an asset class to diversify an investor's portfolio. So first, one of the major pros to real estate investments is that there's deals out there to be had within the real estate market, right? So there's opportunities to buy real estate right, or what I mean by that is buy real estate at a price below the market price. So if you buy a stock, for example, you're going to pay whatever the price is at that particular time of the day for that stock. You're going to pay the market value. Where in real estate, there's opportunities, like an example would be if a seller has a tax liability that he needs to meet at a certain time, he may be willing to sell a property to get a quick sale done at a lower price. Or if, as an investor, you're in a strong cash position and you're able to make a cash offer on a property, that may be very attractive to the seller, and you may be able to acquire that property below market price. Now, of course, if you acquire property below market price, one of the components to real estate is growth, so that allows you more upside on that particular investment. Along with upside on the investment or growth, though, one of the most attractive components of investing in real estate is it typically creates steady cash flows. So you get the dividend, right? Or you collect the rent from that particular property that you own. And if you look at the REIT index as a whole, the average dividend from real estate is 4.3% versus the S&P 500 average dividend is 1.96%. So you typically get a little bit more income from real estate than you would from investing in stocks. And another very powerful component is the depreciation of real estate, which can make a decent portion of that dividend you're collecting essentially tax-free. So you're able to get tax deductions from expenses related to real estate, and it's under the premise that you're telling the IRS that a piece of real estate has a determinable shelf life or value of time that erodes over time. Now, the time is quite long. For a commercial property, you can depreciate it over 39 years, or you can depreciate an expense over 39 years. And in residential, it's 27 and a half years. However, there are some ways to depreciate your expenses a little bit faster, depreciate the real estate a little bit faster. There's something called a segregation study that some funds do, which can allow them to reclassify certain expenses to be depreciated over a shorter period of time, usually they're 5 or 7 or 15 years. But the way it works is essentially, let's say a supermarket bathroom, you pay to repair a sink, right? That's a building maintenance expense. So that's going to be over the 39 years for the commercial building. But let's say a restaurant sink in the kitchen repair, because that's directly related to the ongoing business, in some scenarios, you're able to depreciate that over a much shorter period of time, either the 5 or 7 or 15 years. So that's the way investing in real estate, the income can have significant tax benefits, where only a portion of that income that you're getting is added on to your tax return for the end of that particular year. So there's a lot of scenarios where it can be used strategically in non-qualified accounts to essentially generate some tax-free income. So the third one is that real estate historically appreciates in value, right? Real estate can go up just like the overall equity markets. So over the last 20 years, from 2002 to 2022, the Fed Reserve says that the median home sales price has gone up 238%. Now, to compare that to the S&P 500, over that same time period, over the last 20 years, the S&P 500 is your $1 invested is worth $3.96. So it's gone up 396%. But if you adjust that return on the S&P for inflation, it brings that return down to just a little bit over 200%, which can also be an attractive component of real estate in that it's usually seen as a hedge against inflation, meaning as inflation goes higher, real estate values usually go higher as well, and the real estate will get bid up to keep up or even grow faster than inflation, which historically it has. The next one, the next benefit is some of the tax benefits of the gains in real estate. So there's a lot of different programs out there that the government offers. One I'm sure that you've heard of is the 1031 exchange, where if you sell a property and you have a capital gain, instead of paying tax on that capital gain, you can just roll the entire proceeds from the sale into another property. So this allows investors to go sometimes even in multiple generations and defer the tax indefinitely on that real estate investment. There's also something called DSTs, which is similar to a 1031, except instead of doing it yourself and going out and identifying a property and rolling the gains into it, it's a fund that does it for you, but it provides the same tax benefits, tax-free income and some tax-free growth or tax deferred from that investment. And the last one is the opportunity zones, which opportunity zones were created in 2017 in the Tax Cuts and Jobs Act. And what it is, it's areas in cities that is determined by the federal government to be an area they want to focus development on. So an investor can take capital gains either from real estate or even from stocks, any type of long-term capital gain, invest it into that opportunity zone without paying tax. You defer the tax out by 10 years, and typically you're generating tax-free income and growth during that period of time. So those are some of the tax benefits related to the capital gains portion of real estate. And also there's something called leverage benefits, which is pretty easy to explain. So let's say I'm an investor and I want to buy $1 million apartment complex. Typically, I would finance that either 70 or 80% of it. So let's say I put $200,000 down and I finance $800,000. And let's say over the first year of that investment, my $1 million property generates $100,000 in rental income. Well, that $100,000 compared to my initial investment of $200,000 is a 50% return in 1 year. So that's basically the way to explain leveraging finance to increase your return on real estate, which certainly an investor can do themselves actively or do it passively through some of the funds or syndicates that are available. But kind of going into the cons makes a nice segue, because the leverage component can also act in the opposite direction. So let's say I buy that same property. I put my $200,000 down, finance $800,000, and the property value goes down to $700,000, and I need to sell the property. Well, now my $200,000 that I put in is gone. I have $700,000 that I owe on a loan for $800,000. So as an active investor, this is certainly one of the risks, which is one of the reasons that some of the other methods of real estate investing, be it a syndicate or a REIT, are attractive, especially to a lot of individual or retail investors. Another risk is that income can be inconsistent from real estate. So you're always hoping that your lessee or your tenant is paying rent on time, but it doesn't necessarily always happen that way. And probably more importantly than an inconsistency in rent is the liquidity, which is a major downside to real estate as an investment asset class. So in all scenarios, whether it's a real estate syndicate or a REIT or you're buying a property on your own, it can certainly take time to get your money out of that investment. I think investing or purchasing an apartment complex on your own kind of speaks for itself. It can take several months before you're able to liquidate that property. In a fund, you have public REITs, of course, where you do have full liquidity, but the trade-off versus a public versus a private REIT or a syndicate is in that public REIT that you buy like a stock, you have immediate liquidity, but you're also subject to the volatility and ebb and flows of the stock market. They're going to move with stocks. If the S&P is down 20%, those REITs are going to be down, whereas in a private REIT, you're not going to see the volatility because it's not publicly traded. You'll see some, but not as much as a publicly traded one. But your liquidity is really at the mercy of that particular fund. So usually if you want to exit a private REIT, for example, they do liquidations monthly or on a quarterly basis, but the fund always has the ability to say, no, we're not allowing any redemptions for this period of time. And that did happen a lot in 2008 and 2009. A lot of investors were locked into these non-traded REITs for long periods of time. And also some of them at the original investment have a certain holding period before you can even request a redemption. Sometimes 1, sometimes 3, sometimes 5 years. So that's one of the major downsides to real estate as an asset class is the liquidity. Also liability. So if this is one of the benefits of being a passive investor in a syndicate or a REIT versus actually going out and purchasing real estate on your own, is that you're open to full liability as an active investor. Whereas if you're a passive investor, just a member in the group of investors, you don't have unlimited liability. Your liability is the investment amount that you put in, and you can't lose any more than that. The same is not true as an active investor. Taxation, of course, you have tax on your dividend, and you have capital gains tax, similar to any other investment out there. And also the transaction costs in real estate can be high. So if you're investing in a fund, of course, you're paying the manager or the sponsor of that fund to manage it, makes decisions, do all the maintenance, etc. So there's fees that you're paying within that. Whereas if you're an individual investor, you're still going to have some significant carrying expenses for taxes, maintenance, maybe mortgage insurance, but you're also going to spend a lot of your time and effort in maintaining and keeping that investment afloat and keeping it profitable. So these are just some of the major pros and cons of real estate investments. Next I'll discuss real estate syndicates more specifically, and also REIT investments. If anyone ever has any questions about the real estate market, certainly reach out to me. My name's Andrew with Jesani Wealth Management, and my number is 954-800-8552. Okay, thank you, everyone.